Welcome to the deep dive. Today, we're going to get into the weeds. We're not talking about, the price of Bitcoin or the latest meme coin.
No.
We are diving deep into the actual engineering, the really complex stuff that goes into serious institutional grade crypto trading.
Mm-hmm.
Our mission today is to really understand the machinery behind it all, the data rigor, the advanced AI, and the fundamental infrastructure that defines the absolute cutting edge.
It's a great topic.
We've got a stack of sources that takes us on a journey, really.
Yeah.
From the statistical foundations of backtesting, all the way to a high-frequency trading AI called EarnHFT, and then finally to an architectural fix for the whole fragmented blockchain problem, Overledger.
What's so fascinating here, I think, is this idea that volatility doesn't have to equal chaos, not if you apply enough systematic rigor.
Right.
We're looking at systems designed to turn what feels like speculation into, statistical probability. We're covering three essential layers today. There's the validation layer.
So minimizing risk.
Yeah, that's exactly, through data. Then the intelligence layer, which is all about hyperspeed, adaptive AI. And finally, the connectivity layer, which has to solve the inherent communication problems between all these different blockchains.
Okay, let's unpack this.
Let's do it.
So we have to begin where all systematic trading must begin. Validation.
Has to.
The sources basically argue that if a strategy hasn't been rigorously backtested, it's not trading, it's just gambling. This is the process that validates profitability and, optimizes your parameters before you ever risk a single dollar of real capital.
And this is where most systems just fail immediately because they're using garbage data.
Right.
It is not enough to just have the standard open, high, low, close, and volume data, the OHLCV. For a realistic simulation, especially in volatile markets, you absolutely need order book depth data.
Can you explain why that's so critical?
Well, without knowing the liquidity, the buy and sell orders available at different price levels, you just can't accurately model things like slippage or execution costs.
That's a huge point. So if your backtest just assumes you can buy $1 million of BTC at the exact current price, you're basically lying to yourself.
You're setting yourself up for failure, absolutely. And you also need to account for real-world costs, like the historical fee structures on exchanges.
And what about survivorship bias? I feel like that's a big one in crypto.
Oh, it's massive.
Yeah.
Because crypto markets are 24/7 and just so dynamic, strategies have to account for what the sources call corporate actions.
So things like forks and airdrops.
Forks, airdrops, and this is the crucial one, delistings. If you only test your strategy on the coins that are still trading today,
you've ignored all the ones that went to zero.
Exactly. Your historical success rate will look amazing because you conveniently ignored all the failed coins that your strategy might have traded and, lost a ton of money on.
Okay, so once you have the clean data, how do you even measure success? It's clearly more than just the total return. What are the non-negotiable risk metrics?
The primary one, especially in crypto, is maximum drawdown. This tells you the single largest peak-to-trough decline the strategy ever had. It's your worst-case scenario.
Your stare at the ceiling at 3 a.m. number.
That's the one. But you need to combine that with risk-adjusted returns. Mm-hmm. Most people have heard of the Sharpe ratio, right? It measures your return per unit of risk.
Mm-hmm.
But here's a deeper insight for crypto. Because the volatility is often skewed, you get these massive sudden upside moves, the Sortino ratio is arguably more relevant.
How does that differ?
It only penalizes downside deviation. It ignores the good volatility from big upward spikes, so it gives you a much truer picture of performance relative to the bad kind of risk.
That makes perfect sense for an asset class known for those crazy rallies.
Yeah.
So what are the gold standards? What should we be looking for in a great strategy?
The sources are very specific on this. An excellent strategy should be aiming for an annual return of over 30%. It should keep its maximum drawdown below 15%, and it needs to hit a Sharpe ratio, or ideally Sortino, of greater than 1.5.
Okay, now for the reality check, I think this is probably the most important takeaway for anyone building these systems. If your backtest spits out, say, 200% annual returns with a tiny 5% drawdown.
Red flag.
A huge red flag. The sources explicitly warn that you are almost certainly looking at an overfitted strategy or just flawed data.
Exactly. You've basically taught your algorithm to memorize the past noise instead of finding a real repeatable signal. Realistic, robust crypto bot returns are much more modest. We're talking 15% to 50% a year with drawdowns in the 10% to 25% range.
So if it looks too good to be true.
It is, without question.
So how do you actually prevent that? How do you guarantee a strategy can generalize and hasn't just memorized history?
It requires dynamic dynamic testing. The key technique here is called walk-forward analysis.
Okay.
So instead of training your strategy on the entire historical data set at once, you use a moving window. You optimize your parameters on, say, the last 6 months of data, and then you immediately test it on the next 3 months of completely new, out-of-sample data.
So it's always being tested on data it's never seen before.
Precisely. It's like your target is constantly moving, which forces the strategy to be robust and adaptive rather than just repeating an old pattern it memorized.
That makes a lot of sense. So that foundation of backtesting gives us confidence.
Right, but if we connect this to the bigger picture, even a well-validated strategy is going to crumble when the market regime shifts, and the crypto market is, well, intensely non-stationary.
So how does modern AI actually tackle this volatility at high speed?
That brings us to the really cutting-edge stuff, hierarchical reinforcement learning, specifically this framework called EarnHFT.
And the challenge here is just immense. Traditional RL agents, they face two huge problems in high-frequency trading. First, the time horizons are incredibly long. We're talking about agents that might have to make decisions over 2.4 million steps a month.
It's a massive, inefficient training space.
And the second problem, which is what breaks most strategies, is data drifting. An agent that you train during a raging bull market is, worse than useless when the trend suddenly reverses. It just can't maintain performance.
And EarnHFT's design is fascinating because it's built around admitting that. It admits that no single agent can reliably predict the market long term. So they use this 3-stage hierarchical solution to solve both the efficiency and the drift problems at the same time.
Okay, let's start with stage 1, the efficiency fix. Efficient RL with a Q teacher. How does that speed things up so much?
Well, think of the Q teacher as the perfect all-knowing mentor. It computes the optimal action value by basically looking ahead at future price info, which of course a real trading agent can't do.
So it's cheating in a way.
It's cheating for a good cause. This optimal value is then used as a guide, or a regularizer, to train the real agents incredibly quickly. The sources showed this one component could cut the training steps needed by up to 85%. It just skips all the pointless trial and error.
That's a huge time save. Okay, so that handles efficiency. Then we get to the core problem of market drift with stage 2, the diverse agent pool.
This is where the framework prepares for war, essentially. They don't just train one agent, they train hundreds. And each one is specialized with different preferences for, market return rates.
So you end up with specialists, an agent for a bull market, one for a bear market, one for just choppy sideways action.
Exactly, for bull, bear, volatile, sideways, rallies, all of it. Then they select only the absolute best performers from each category to form the final pool of specialists.
And that leads to the final, clever piece of the puzzle.
Okay.
Stage 3, dynamic routing optimization.
This is the hierarchy. They train a high-level router that operates at a slower pace at the minute level, and its only job is to pick the right tool for the job.
I see.
Based on the market conditions it sees right now, this router dynamically switches and picks the single best second-level agent from that pool to handle the actual second-by-second trading for the next 60 seconds.
So it is literally hiring and firing its specialists every single minute based on real-time volatility.
Yes. It just highlights the sheer instability that AI is designed to combat.
And the results. Did it work?
Oh, yeah. The results really proved the value of that frantic adaptability. EarnHFT significantly outperformed 6 other state-of-the-art models.
Wow.
Across all sorts of different pairs like BTCT-USD, ETH-SDT, it exceeded the profitability of the runner-up by at least 30%. The router's ability to just instantly shift from, say, a bear market specialist to a volatility specialist is what kept it stable and profitable.
Okay, so what does this all mean? We have rigorous validation, we have a cutting-edge AI strategy that can execute minute by minute. But even the best AI is useless if the underlying infrastructure is broken and fragmented.
Right.
If EarnHFT wants to do an arbitrage trade that crosses from Ethereum to a sidechain, that's where the whole system can just break down. So let's dive into Overledger as a potential solution to this DLT silo problem.
This is the fundamental challenge. Distributed ledger technologies just don't talk to each other seamlessly, and this forces applications to be single ledger dependent.
Which increases risk, drives up cost.
And it severely limits mass adoption. Imagine trying to build a global app, but every time you want to switch your database, you have to rewrite the entire thing from scratch. It's untenable.
So Overledger's approach is to be a kind of blockchain operating system, an OS.
Yes. It creates this vendor-independent overlayer, or the presentation layer, that just sits on top of all the existing ledgers. And this is a really critical distinction the sources make. Unlike competitors like Cosmos or Polkadot, which rely on a central hub or a relay chain.
A single point of failure.
A huge single point of failure. Overledger uses a multi-layered approach that explicitly avoids that.
And its architecture is all about translation and guaranteed ordering, right?
Pretty much. The first layer is the messaging layer. Its job is to standardize information coming from these radically different ledgers. Whether it's a Bitcoin script transaction or a complex smart contract message from Solidity, it translates everything into a common format.
Decoupling the business logic from the specific chain's language.
You got it. And then things get more complex at the filtering and ordering layer.
This sounds administrative, but I assume it's critical.
It is absolutely crucial for validity. This layer filters messages based on the application's rules. But more importantly, it has to correctly order transactions that cross different ledgers, using mathematical concepts from order theory.
And what's this about a verification block?
That's how it deals with forks. It provides a point of consensus for these multi-ledger events, making sure all participants agree on the state of the world before the transaction proceeds.
And finally, the application layer sits on top of all that, running the actual multi-ledger app. But let's get back to the why. Why is all this complexity necessary? Why can't we just do a simple transfer across two chains?
And that gets to a really important question about transaction integrity. When you do a transaction on a single ledger, you usually get what's called ACD properties, atomicity, consistency, and so on. But a cross-ledger transfer breaks atomicity. A simple transfer from chain A to chain B is actually two separate operations. If the second part fails, the first part is still committed on chain A.
And now your whole system is in an inconsistent state.
Exactly. So this layered structure and the need for complex coordination like the two-phase commit approach Overledger uses, it's all necessary just to restore that basic guarantee of atomicity across this fragmented infrastructure.
It's basically building the infrastructure needed to deliver what users already expect, but which DLTs can't provide on their own.
That's a perfect way to put it. And this modular structure also has really practical advantages for designing complex apps. The sources point out it's a natural fit for the CQRS-ES pattern.
Command query responsibility segregation.
Yeah, where the rubber meets the road. This pattern lets you use separate models for writing data and reading data. In Overledger's world, that means you can use different chains for different jobs. You could use a cheap, fast chain for high-volume trading commands.
And then store the permanent, verified state on a separate, super secure, maybe slower chain for the read aggregates.
Precisely. You optimize for performance without sacrificing security where it actually matters most.
What a journey. I mean, we covered the absolute necessity of backtesting metrics, including why the Sortino ratio might just be the unsung hero of crypto risk analysis. We then explored how Earn HFT uses this hierarchical AI hiring and firing specialized agents every single minute to battle market volatility. And finally, we detailed how Overledger's layered OS tries to fix transactional integrity across a fundamentally fragmented DLT landscape.
You know, the sources reveal this fascinating tension in the space. On one side, you have this relentless push for hyperspeed, adaptive AI-like Earn HFT, optimizing its whole approach every 60 seconds.
Right.
And on the other, you have this persistent structural fragility that comes from DLTs just not being able to talk to each other, breaking basic transactional guarantees. It's a battle between these incredibly smart human-designed systems and the deep limitations of the underlying architecture.
So here's the final provocative thought we want to leave you with. If these incredibly sophisticated AI strategies need to be ready to switch their entire approach, their fundamental understanding of the market, from bullish to bearish to neutral every single minute, just to maintain that 30% profitability,
Yeah.
what does that fundamentally reveal about the level of predictability and stability that actually exists in the core cryptocurrency market structure? And what is the long-term relevance of any traditional fixed trading strategy when the most advanced algorithms out there are designed for minute-by-minute tactical warfare?
Something to mull over.